Hey everybody, this is Jose Blasco here. We are about to get started in just a moment. Before we start, as always, it's always nice to have a quick sound check. The way to do it, a quick hello on the chat box. When you type it, it's nice to read, and it means that you heard me. So sound is good. Let's do that, please. We got 30 seconds to go, and we begin. Thank you so much. And thank you as well for joining me on Saturday. Weekend session is always extra appreciated. I mean, in a way, it's very relaxed to get together on the weekend when the markets are closed and we can just focus on lecture time if you wish, no need to rush. But on the other hand, of course, it also may imply an extra effort on your end. So very, very, very appreciated. Thank you so much. Thank you, Joe. Thank you for confirming. Very good. That's it. Time to get started, everybody. So welcome to the session, everyone. Today is September 17, 2022. My name is Jose Blasco. This is a sharpening session. We do those on the weekends, so we can just take it easy when the market is closed and focus on lecture time, questions, and things of that sort. Okay, so no need to rush. Relaxed today. Before we get started, as always, I would like to highlight the financial disclaimer. So please read it carefully. It's always the way we start the session. It's always the same disclaimer, fairly short, very important, and therefore counting on you all to read it completely. Thank you so much for that. Jeff, Mark, good to see you all. Wonderful, guys. Thank you for joining me on the weekend. And again, the plan for today is a little bit of lecture time. We may have trade plan reviews, we may have questions, we may have answers, we may have really anything, okay? And as we are now starting the session, of course, I am ready with a specific topic I have as a plan to cover today, but that doesn't mean it's going to be a topic today because that really depends of questions that you guys may have. So if you have any question and you would like to start the session with any question, concern, observation, curiosity, you name it, anything, this is the right time for you guys to phrase it on the chat box so I can take care of that first and leave my ideas for the session for today for the latest part of the session, so that way I'll make sure I don't miss you. So go ahead and I'll give you just let's say a minute or two to type it on the chat box. And if you don't have any question or anything like that, so not an issue, I'm ready to cover a specific topic, which I believe will be interesting for everyone. But certainly I would like to give priority to you instead of to my topic. So feel free to type. Okay. I'll just wait a moment before we get started. I'm just monitoring the chat box here. Yeah. So just wait a moment. If you don't have any topic, it's fine as well for you to type. I'm all good, no topic for me or something like that. So it's also nice to get that confirmation, so I don't need to wait for too long. Maybe I'm just waiting and you guys are waiting too, so which will not be that efficient. So let me know if there is a question or there are no questions, and that way I know what to do next. So we use this time together as wisely as possible. Okay, so I'll take a sip of water and I'll check the chat box again. And if there's nothing, then I'll just start with my topic. Jeff, please help with Len. Okay. Yeah, very good question. And I do remember you bringing this the other day on Thursday when we had a session. Now that you talk about it, I remembered. So that's a great question, Jeff. Thanks for that. Mark, no questions at the moment. Got you. Okay, so let's begin with Jeff's question. We'll talk about Lennar Corporation, okay, which is a trade that we had running. This is a trade which, let me see if I have it here. I'm just loading on another screen, TOS. So hopefully I still have it, because I believe that inside the positions panel, I believe I got rid of it because this was a trade that basically was going to be over yesterday on Friday. Yes, I got rid of it. So then it doesn't show here. So hopefully I have it on TOS. If not, it's okay because I cannot remember. But basically, the last step of this trade, let me write it down. The last step, this was an iron condor for the ones of you watching this session and you didn't know what was this trade. So this was an iron condor where we expected the price of that stock to stay in the purple area. And that was not the case. The stock started moving down aggressively all the way to expiring at 75.79 on the expiration date. Okay, so now this trade, that was an iron condor, which was made of initially. Funny. I got a message from Thinkorswim that says that they are doing maintenance, so I'm not going to be able to launch it. But anyway, so this trade was done originally. It was made, if I'm not mistaken, by buying the 95 call and selling the 95 call, and then much lower we were selling the 75 put, and we were buying the 74 put. Okay, so this was the original iron condor that we had traded, which as that stock was going down and down and down, and we acted on the specific rules that we use for management of the trade. So we ended up converting this trade to an iron butterfly. Okay, and I won't get into that because we talked about this on the Thursday. What I'll talk about is, the in the money, out of the money situation that we have. So basically, we got the 76 call. Okay, and then we also got the 75 call short. Okay, so this is the iron butterfly that we ended up with after the multiple conversions. Okay, and this is where we ended up. Okay, Jeff, please, if you could confirm that this is what you have in your account, that would be great, because I believe, I'm pretty positive this is the case. It's so many trades to remember, so I'm concerned that maybe I'm not remembering correctly. Okay. Joe, your TOS logged in. Interesting. I mean, I guess that my TOS account is actually TD Ameritrade Singapore. It's not TD Ameritrade US. So maybe they are doing some maintenance with the servers here in Asia. I guess that's what it is. But anyway, so 74, 75, and 76, those are the strikes. So I'll wait for that confirmation, Jeff. That would be great to get from you, even though I'm pretty positive that's the case. Okay. Okay. So when we look at this situation, okay, and this is an iron butterfly. So we have, I'm just going to try to explain this trade horizontally speaking. Okay, so iron butterfly, yes, I exit the put side, but left the call side on and went to sleep. Got you. And then the stock ended up closing at 75.79. Okay, and the stock ended up trading at 75.79, which means that because you don't have the put side, so then forget about it. All of that was a profit that you collected, and that's over. But then on the call side, the stock ended up in the money when it comes to the 75 call, and out of the money when it comes to the 76 call, which means that because the 76 call was out of the money, so then what happens is that it expires worthless, and you don't get anything in exchange. There is no auto exercise, because for you to get into an auto exercise situation, you need the option to be in the money, but that one was out of the money because 75.79 is less than 76, being a call. Now the 75 call was in the money by 79 cents, and that one, when it expired, it produced an assignment. Okay, it produced an assignment. So when you look at your account, you should find yourself short 100 shares of that stock at 75. Okay, that's what you should find yourself in. You should find yourself in a position where you are short 100 shares at 75. So let me write it down to avoid confusions, because assignment and exercise is often confusing. If it hasn't happened too many times to you, it's often a source of confusion. So you should be short 100 shares at 75, which obviously, given the fact that the stock is 79 cents higher, so obviously that is generating a little bit of pain on your side. You are underwater by 79 cents times 100 shares. So that's the level of pain you got. Now, the issue with that situation, and I would personally not have gone to sleep and leaving it like that. I would have done something, against it, and I'll give you a few choices now. But the issue with that situation is that now you are a bit exposed to luck, because if you still had the 75 call and the stock gaps up, let's say to 85, let's point at something crazy. So let's say the stock gaps up all the way to 85. Well, from 75 to 85, you're going to lose $10 times 100 shares. That's a lot of pain. Now, if you still got the 75 call, it doesn't matter how high the stock gaps, because the most you can lose is the distance between strikes, which is $100. So that's the most you can lose. So it doesn't matter really, right? But the problem is that at this moment in time, you don't have the 75 call because it expired. And the I think I said 75. I meant 76. And the 75 got assigned, converted, and therefore has been converted into 100 shares of stock short. So what happens is that two things may happen. On Monday, you have a gap up. That would add pain. Or on Monday, you get a gap down. That's a lucky situation. And that would actually create a free profit, which obviously, that would be a nice to have. But again, it's basically getting lucky, okay? Which we should never put ourselves in a position to check how lucky we are, because it's a form of gambling, isn't it? And sometimes it's just a mistake in an execution. Sometimes it's a distraction. So obviously we are serious traders here, no matter if we are experienced or not, because our group, in our community, we have many traders that are new to trading, and some of you guys have been trading for a long time. So, but no matter what, we are all human, right? I myself make mistakes from time to time. I myself may get distracted. Sometimes it happened to me being in Asia that, for whatever reason, there is a holiday on Friday or Monday and I forgot or something like that. And so, making mistakes is human. We need to count on that, okay? But at the same time, the least mistakes we have, the better. So what's the situation here? Well, the situation is that because the 75 got assigned and the 76 got expired worthless and did not convert into an auto exercise of anything, so you are net naked short 100 shares at 75. Now, you are not fully net naked in the sense that the trade you run with Lennar Corporation did create a little bit of a profit, right? So if the stock was to gap against you on Monday and makes you a little bit of a losing position, the losing position you get on Monday minus the profit you collected from the structure that you have traded, may not be too bad. But at the same time, what if you got a big gap against you? That's the big concern, right? So again, I'll talk about what we can do in situations like that. But before, I want to get back to you to confirm to you all that we all understand that in this particular case, we are short, naked, 100 shares of stock at 75 with a little bit of a profit collected, but we are net naked 100 shares at 75. And if the stock gaps on Monday gaps up, that's a problem. If it gaps down, that's just being lucky. Everybody with me on that, could you please confirm that you understand the situation in which we are in? And I will talk about it, what to do so you don't go, you don't leave your screen and go to sleep. Jeff, you are in Asia just like myself, so I totally understand you, my friend. So you don't leave your screen and go to sleep without doing something. So I'll talk about what can we do in situations like that to find ourselves short or long naked, because being long or short, it's just as bad because the stock could gap against you. It doesn't matter if it's short or long. The word short doesn't mean anything really. And then I'll talk about, okay, so let's say we got distracted, okay, because this, even if you know that you don't want to do that, sometimes we get distracted. We are human. So if you got distracted, what is it that you can do to try to, avoid too much pain? Okay, so I'll talk about the two cases. But first, I need to understand that you understand the situation in which we're in. Okay, so let me take a look at the chat box here. Yeah, Mark, I can see that you are also logged in TOS. Yeah, in my case, I just got this. I mean, I can show you the message from my other screen. Oh, shoot, I closed it. Okay, so I'm going to relaunch it, and I will show you. Joe, short-term, long strangle to protect. Okay, so talking about options in a moment, or just short shares, short-term, long call. I'm getting back to that, Joe. And Mark understands. Okay, Jeff. Oh, look at that. Now it's allowed. No, not yet. Yeah, it does not allow me to log in. So you can see here it says Thinkorswim is undergoing maintenance. So yeah, cannot log in. You see that? So yeah. So I'm gonna have to wait. Maybe later in the session I can do it. Jeff, yes, understand. I have a working order to close the sell call but it didn't fill. Okay, got you. So you tried, okay, but it didn't get filled. And this, by the way, is something to expect, okay? So, which is something I need to address. So what to do to avoid that problem, okay? So let's talk about first what to do to avoid being in that situation. And then we'll talk about what if you're in that situation, what can you do? So case number one, what to do to avoid that situation. Well, first of all, you need to expect that getting filled on the last trading day when an option cycle is about to expire, it's going to be tougher than any other time, okay? Especially if we are now dealing with, getting very close to the end of the trading day. So liquidity goes away. There will be many times where you see no bid. There will be many times where you see no ask. And and maybe getting filled implies a major slippage. So that makes it difficult, okay? So that makes it quite difficult, and sometimes it's just not possible. Like in your case, you did not get filled. You had the order in, and maybe you could argue that, hey, if you had stayed in front of the screen and the stock had moved a bit more towards, the 76 strike, and you negotiated a bit worse price, and now you got filled. So this could happen, but still, the reality is that as you are getting closer to the expiration date, and I would say this applies to the whole 6 hours and a half of trading on the last trading day, that's a tough day to get filled. And definitely, if you are looking at the last 2 hours or the last 1 hour, it's kind of like forget about it. No one would want to take the other side, because why would you, right? The option is about to expire. Why would you? Especially if the option is not clearly in the money, and even like that, it's going to be very difficult. So this is something you need to expect. So when it comes to thinking about options that you could implement, okay, well, first of all, let's remember what is the risk graph of an iron butterfly. The risk graph of an iron butterfly looks like that. Okay, in our case, in this particular case, the midpoint here would be 75. Okay, that would be the midpoint. So in that day, the stock started trading below 75, and during the trading day, the stock rallied and got to 75. Right? So what should you do when you get more or less to the midpoint? This is a case where, especially after we ended up with an iron butterfly, having started as an iron condor, and I believe I did mention that on Thursday, this is a case where you just cannot leave it alone. You need to be on top of the trade, and you need to be active at trying to get out. So let's say that we were lucky and the stock rallies pretty strong right at the open, and let's say 30 minutes, 1 hour, 1 hour and a half after the open, you are hitting 75. You still got 4 or 5 hours to go before the market closes. I would say you have a pretty fair chance at closing the put and the call side, and you should be able to do that, okay, if it's happening early on the day. Now, let's say you got distracted. Let's say your other obligations don't allow you to be in front of the screen at the time. Let's say there was not enough liquidity, and even though you tried to get out, you could not get out, okay? And now you either find, in that situation where the market is ready to close, basically, and it's either you're going to be short shares above or long shares below the 75 strike, and now you are naked shares into Monday, and now you got a problem, right? So what can we do? Now, also notice that the one thing to be done is if you are below 76 or if you are above 74, meaning you are going to get a sign on 74 strike and you won't get auto exercise on 74 or 76 strike. Because if that stock rallied past 76 and kept going, and on expiration is trading at 80, obviously the 75 gets a sign, the 76 get auto exercise, so you're in, you're out, you lost what you want, $100 minus whatever premiums you have been collecting during the life of the trade, which may put you in a profitable position depending on all the rolls you have done and how much efficiency these brought in. But obviously, if you go beyond the strikes, typically you will end up with a loss, a small one, but typically a loss. So the beauty is that there is nothing for you to do. But on the other hand, how do you know in the last minute you are not going to have that stock to crash crazy and end up below 76, right? And now, like 1 hour before going to bed if you're in Asia, or going to lunch if you're in California, for example. So, 1 hour before the market closes, let's say you're in California, 1 p.m., and you went for lunch at 12, and, the market was trading close to 80, and you're like, no way, it's going to be below 76. Well, guess what? It could happen that it crashes very aggressively, and then next thing you know, you are in the same situation Jeff is, which is you are short naked share at 75, and you are not out of it because the 76 strikes was out of the money. So you could be in that situation. So again, the first thing I want to say is that if you find yourself in that situation where you have to do maintenance, massaging, you end up with an iron butterfly. The last trading day, you have to be on top of it. Okay? Or, you close it the day before, you don't do the butterfly, you get out and you take the loss or whatever it is, and that's it, done. Because you could get a worse situation if you get negative shares, long or short, like we have in this particular case. You can get a major gap against you, and that would be a bigger problem, right? So no gambling, no hoping. If you're not going to be able to manage the trade on that last trading day, just make sure you're out before that situation, okay? Okay, now, what are the things that you can do in that day? Okay, what are the things you can do? So again, option number one, as I was telling you, observe price action in the beginning part of the trading day. And let's say that, as I said, in the initial 1 hour, something like that, you get to the midpoint, which in our case was 75. Try to get out. I would say most of the cases you should be able to get filled, and that's it. And now you end up with a little bit of a profit. Great, done. What if you cannot get filled? Well, if you cannot get filled, the one first thing you need, sorry for that, I just made a mistake here, sorry. If you cannot get filled, the one thing that you need to forget about it is the fact that you were trading September 16 expiration. Okay, so forget about anything in September 16. If you're not getting filled, nothing in September 16 is going to help you. Okay, nothing in September 16 is going to help you, because again, the reason why you didn't get filled at 76 is the lack of liquidity and everything I said before. So what are your choices? You basically have two choices. So choice number one is use shares. Okay, and I will explain that in a moment. Case number two is to use the next expiration date. That's case number two. Okay, why next expiration date? Well, because the next expiration date is gonna have liquidity, and then you're gonna be able to buy a call to protect the short position in which you are. Or using shares, it's certainly something that you can do, even though it has a worse outcome when it comes to the buying power required to get into a share position versus getting into a long call. Okay. Now, before I get into more details, let me tell you my favorite way to approach it is going to be to use shares. And why is very simple, because for the majority of stocks, we got post-market trading, and you can, after the market closes and you now know the closing price, you now know if you're going to be in trouble or not, and then you can add shares to offset the issue or not. If you are trying to buy the call, in this case, buying the 76 call that expires next week would be the right choice to protect the position, isn't it? You will lose a little bit of time decay over the weekend, but if you got a gap against you, it's not a problem because that call is protecting you. You can even buy the 75 call, right? So that way, you protect to the maximum, even though you would have a little bit more time decay there. But that would be a great action to be done, isn't it? To protect the position nicely. But what's the problem? The problem is that, let's say the market it's trading at 75, 79 in the last 5 minutes of trading, and you're like, okay, that's it. It's 75, 79. I'm going to get assigned on the 75 call. I'm not going to be auto-exercised on the 76. So time to buy, the 75 or the 76 call. I'm going to use the 75 call that expire in the next expiration date. Okay, so next weekly. Okay, and guess what? Now let's say you get unlucky, which could happen. It's called Murphy's Law. And now you did that 5 minutes before the close, and guess what? 10 seconds before the close, the stock rallies and closes at 76.01. Right? So if the stock closes to 76.01, okay, well, guess what? You got assigned the 75. You got auto-exercised by 1 cent. And now you are left with no shares, but you are left with a long call into next week. Not too big as a deal, much less risky compared to being long shares, but still, if the stock gaps aggressively, you're going to lose a lot of what you pay for the 75 call. It's never going to be as bad as owning the stock because we got gamma decreasing the delta, so it's going to be okay, but still a problem. Or, worst case, you buy the 75 call because the stock is trading at 75, 79, and on the last 10 seconds, on the last 20 seconds of the day, the market drops crazy and ends up below 74, right? So now you lost a lot on the 75 call and you own nothing, okay? Or even worse, the stock ended up below 75, right? But not below 74. So now you are long shares because you got a sign on the put. So you are long shares and a long call, both. So that's why using the shares is my favorite choice to try to mitigate the issue when you cannot get out or you got distracted. Using shares is what I like the most because you can act on the post market session. So the stock market stop trades at 4 p.m. New York time. You now look at the last trading price. It's the closing price of the day, 75.79, and you're like, that's it. I'm going to be assigned. I won't be auto-exercised. So what can you do? Well, you would want to counteract what the assign option gave you, right? So if the short 75 call got you a short 100 shares at 75, so what would you do? You don't see that on the account yet at 4 p.m. on Friday, 4 p.m. New York time on Friday. You don't see that in the account. But you will see that on the Saturday, on the Sunday, on the Monday, depending on your brokers. They may update that sooner or later. But you will see that in the account anytime. You will see short 100 shares. When those options disappear, they will be substituted by short 100 shares. So what can you do, let's say at 4:05 p.m. New York time, 5 minutes into the post-market session? What can you do? Well, you can then go long 100 shares. Okay, at whatever price it is in the post-market trading session. Okay, we can chart it actually. So let's move to a 5-minute time frame, and I am going to look at format, and I'm going to look at show all sessions. So if we look at post-market, so notice how there are multiple dots and things that took place here. All of those are trades that happened in the post-market. Those are very, very few trades only, isn't it? But notice how the stock, traded as low as even below 75. So again, you cannot know that for sure. Okay, you should not be trading intraday the post-market trading session because objectively there is no liquidity. Notice this is a 5-minute time frame. You don't even have candles. You just have little lines. Even if I look at the volume, let's see how much volume we got. So volume. Well, actually, you got 1,500 shares traded here, and then everything else is basically nothing. The last trade was 100 shares. So very little volume, but it's tradable. Okay? So the plan that I'm suggesting here when something like that happens is to come into the post-market trading session, okay, and try to get filled. And in cases of Jeff and myself, being in Asia, you're going to be like, wait a minute. If you're in Singapore, if you're in Malaysia, that's 4 a.m., right? What do? Well, you got two choices, Trading is trading. This is a responsibility we got. So, look, you set up the clock alarm, you wake up, you come to do it. Or you can place a conditional order, right? So you can come into 2IS and say, hey, buy 100 shares of Lennar Corporation, okay, if the price of the stock, is trading, between this price and that price, at 4 p.m. You could do that, and you do an order like that for going long. You do an order like that for going short if you are between 75 and 74. You could do that, but to be honest, it's quite complicated to execute. And on top of that, you may not have liquidity. You may place a limit order and you don't get filled easily. You get a market order, you get killed on slippage. So look, when I got distracted, I basically, with a lot of, love for myself, but I do give myself a little bit of a slap on the face, and I'm like, okay, let's set up the clock alarm and do this manually. Because, again, being in Asia, that's a disadvantage when it comes to the time. If you're in the US, 4 p.m. is not a big deal, right? So you will want to come in here, place a limit order, and the bid and the ask would widen. So you are trading shares, but the approach would be similar to trading options, where we often negotiate a price in between the bid and the ask, and we wait to see if we get filled. So you just wait until you get filled, and you would have got filled at whatever price. Maybe you got lucky, you got filled at 75. Maybe you got unlucky, you got filled close to 76. But guess what? You are long shares at 70 something, and now the assignment process kicks in, getting you short at 75. So long shares at 70 something plus short shares at 75 because of the assignment will get you flat. So when the market opens on Monday, you got nothing in the account. So you remove the problem as soon as you could, which minimizes the probability of the stock to move too much against you. Okay? This is my favorite approach to fighting the problem. Okay? Joe mentioned, what about I do a long strangle? I would not recommend you that. Why? 2 reasons. Long strangle means that you are long 2 units, so you're going to suffer time decay times 2 for 2 days over the weekend. So the long strangle is going to add pain to the situation. Now, would that protect, again, a major gap? Yes, but it would protect you poorly, because a long strangle will have a limited delta amount since you are long a call and long a put. So if you are short shares or long shares, if you're assigned, you are 100 delta positive or negative on the underlying. You are 100 hard deltas, positive or negative. If you got a strangle, you start with delta 0. How big of a move you need for the delta to pick up? And even worse, how big as a move you need for the delta to go all the way to 100? Well, you need a major move, and obviously you just need to look at the break-even points of a long strangle. The break-even points is the price paid for the premium. So you need the stock to have a crazy move for the strangle to protect you properly, which means that you are basically ready to lose the whole amount of premium paid for the strangle to protect again that crazy move. So it's not going to be efficient. Okay, it's not going to be efficient. Is it better than doing nothing? I guess so. Is it better than acting on the post-market session? I would say no. So we had conversations of that sort before. I mean, and again, I'm just sharing solutions to problems. Of course, solutions doesn't mean free money or guaranteed profits. Obviously not. We all know that. I mean, I'm kind of joking here. We all know that. But at the same time, when I talk about solutions, and I'm sharing solutions from a point of view of pragmatism, which from prior conversations, it's my approach to trading, which often takes me outside my comfort zone, because as an individual, I am a perfectionist. But being a perfectionist in trading often provide less advantages than being pragmatic. So that's what I'm showing you here. Pragmatic here is show up on the post-market session and basically correct the problem that you could not correct during the day trading session, either because you did not get filled or either because you got distracted. That would be the pragmatic approach, which I'm suggesting here as a solution to this situation. Now, let's say the stock you're trading didn't have post-market, which that would be very, very strange, but let's say something happens. Let's say there is a technical issue on your broker and the post-market trading is not working. Let's say the stock is very liquid, and while you're trying to get filled on the post-market trading session, the bid and the ask spreads are so humongously wide and crazy that there is no way for you to get filled. Well, guess what? Try again on Monday. Monday, you would try during the pre-market, not the post-market. Now, could the market gap up and down on Monday? Yes, of course, because you now went through the whole weekend. But of course, we cannot do magic, isn't it? So that's I'm just basically pointing at when it's the earliest you can act is the pre-market session on Monday, which is a few hours. I mean, depending on the stocks, it's 4 hours, 6 hours before the U.S. market opens. So now you may need to get up early if you're in Asia. If you're in the U.S., maybe for us in Asia, it's easy time now. Whatever it is, but try to act and try to get out of the problem, and that will be it. Okay, that's the most you can do, because playing with the options is going to be tricky. During that trading session on Friday, unless you got filled in an early part of the day. Okay, Jeff, please get back to me with a bit of feedback if you got me. If this is making sense to you, let me know, Mark. I see you are in the same situation, so please, I'd love to hear from you as well that this is making sense to you and you understand next steps. Joe, Eric used to talk about hedging with S&P futures in the post-market, but now there are options on micro E-minis. What are your thoughts about that? Well, yeah, if the trade is SPY, hedging on the futures and definitely using the micro E-minis, it's a great idea. But using the micro E-minis on futures, where you are hedging an individual security, that's a lot of hope there, because you are expecting the security to move as much or as little as the S&P. Or even if you did some sort of statistical correlation analysis to see as an average how much the security moves compared to the S&P, still an average, which does not represent what's going to happen on Monday. You may get a crazy gap against you where the S&P is basically doing nothing. So the hedge is not helping you a lot. So yeah, being creative with hedges, it's a classical mistake that many traders make. Again, with all respects, it's too much hope built in, and also the reality is that the amount of extra trading you get with futures is not that much more than what you get with the post-market session on a stock. So I would say look at the post-market and just try to be patient with trying to get a good feel with limit orders. Do not use market orders in post-market. You will get killed on slippage. So just treat it like you would trade an option contract instead of shares, because with shares typically you would be easy going, right? And you may go ahead and use a market order, right? But not during pre and post market. You gotta use limit orders to mitigate the problem of lack of liquidity. You can see here, if I move to a 1 minute chart, so you will see how funny the chart looks like. Look at that, we still got little dots, which means that you got one trade in every one of those 1 minute, right? So now, does that give you a great opportunity to get filled? Yeah, you got many minutes there to try a limit price, to change it, get filled. So yeah, again, it's doable. Okay, it's doable. Notice that we got trades here all the way to 7:46 p.m. in New York, where the market closed at 4 p.m. Okay, so like 3 to 4 hours for you to get filled. You could get patient. You should be able to get filled. Should work. You just need to take it easy. Okay, so way better than using futures. Yeah. Again, Joe, I'm reading your next message. The problem is that the stock is an individual name, which is basically a being that has life on its own and may or may not be correlated on Monday with the S&P, and therefore it's a very hopeful technique on how to hedge. If you are trying to hedge a portfolio, great, but when trying to hedge, and also great to a certain degree, depending on the components of your portfolio, because you may be correlated or not at all with the S&P. But with individual names, not a good idea. Okay, Jeff, wonderful. Mark, how do we find out what time the pre-market opens on Leonard Corporation? It's a tough one. Okay, because there is lack of liquidity. Okay. It's a tough one. So the best way to find out, I would say it's two. I'm going to give you two choices: is to load a very low time frame of the stock. Make sure you turn on your settings for show all sessions. Okay, and with that turned on, okay, go back in time to prior days. Okay, here we go to see the funny candles and look at the time scale, right? So here in this case, the close took place at 4, and then there was some trading all the way to 5:20. So 1 hour 20 minutes after the close. Then look at the prior day. Look at the prior day getting there. So here was the close, 4 p.m., and then you got some trades all the way to here. Here we go, 4:30. So that's 30 minutes. Okay, so by looking at prior days, and the Fridays, okay, because there is expiration, more people are doing what I just suggested. So you're gonna have, you saw on the last Friday was until 7 p.m. But anyway, it's good to look at worst case scenarios. So if you look at any other normal day, so the close is happening here, and you got trading going on all the way to 5:42. Okay, starting next day at 8 a.m. 8:02 a.m. first trade of the day in the pre-market session. So by looking at an intraday time frame the way I'm doing, you will get a feel for how tough it's going to be to get filled and when. Another choice is, of course, you can do a Google search and stuff like that. You can call your broker, talk to the trade desk, and ask them. But again, my experience is that there are so many exceptions with pre-market and post-market that I prefer not to ask anyone. Just look at what happened in prior days and use that as a reference, and be ready to act based on what I saw happen, and set that as an expectation instead of what someone tells you on the phone or whatever you see when you search online. Okay, that would be that's how I do it. That would be the most intelligent or efficient way to do it, I would say. Great questions, my friends. Love it. Yeah. So okay. So how are we going so far? Any additional question related to this topic? Is that making sense? If all is good, please let me know with a quick all good on the chat box, so I know I can move on to the next topic. Okay, and if you have, apart from all good concerning this very good question from Jeff, if you have any other question as well, time to type it. If not, I will get started with the topic I had in my mind for today. But obviously, happy to wait just a moment to give you time to type. Please give me some feedback, even if it's just all good, Jose, go for it. I would certainly like to hear from you, okay? Thank you. Yeah, so it looks like about 1.5 hours before the opening would be a good time to start. And again, depending if it's a NASDAQ stock, a New York Stock Exchange stock, depending if the stock also trades in other exchanges like the Miami Exchange or the Philadelphia Exchange. So again, depending on things like that, some stocks trade many, many hours. But even with stocks that trade many hours before and after the market open, often you get very few trades, right? And therefore, you will see only a few prints on the chart, like I'm showing you now in the 1 minute time frame. You will only see a few prints, even though you could have traded that for since 4 a.m. New York time. But the reality is that, first of all, not too many people in the US are ready to trade at 4 a.m. And second, even if that was to be the case, maybe there are many extremely patient traders with a very set limit price to either buy or sell, and they're not going to move it, just going to wait for all those quantity of hours. So so you may see very few prints only, which give you a feel for when people may trade, which it's a good way to get the answer to your question mark on when should you be there ready to trade. So your 1.5 hour conclusion in the case of Lennar, I would say makes sense, but expect it to be different in other stocks. So just go take a look. It's probably the best answer. Cool, wonderful. Okay, so let's continue, guys. Okay, so let's change topic then. Since I don't see additional questions on the chat box, I'm just gonna talk about the other topic that I have in my mind, which probably will take us to the end of the session. And the next topic I wanted to talk about is setting targets and setting targets, especially for intraday trading. Okay, because if we talk about setting targets for swing trades, like for securities using options, we have so many more possibilities. First of all, we got plenty of time to think. If you're going to be in a trade which is a 3-week trade or a 2-month trade, you have so much time to think. So many things could happen. You could have options that expire. You can be rolling expiration dates. You can be rolling strikes. You can be converting spreads into butterflies. You can be doing all sorts of things. And therefore, there is so much room for trade management that the way on how you set targets could be very, very, let's call it static, and very relaxed. Okay, for example, maybe you got into a trade here with Lennar Corporation, and maybe the way you set the trade was using speed bumps, and if price went above this high, you were setting a target, and this is where you took profits, and it took a long time. Or maybe you're still in the trade shooting for this midpoint here at 91 something, and it go there sometime. You may still be on the trade, and the fact that the market went your way already allow you to do some sort of options trade massaging, and you converted again your spread into something else, and you are locked in a profit. And even though the stock now is dropping against you, doesn't matter. You're in a sure thing profit, and if it rallies against your final target, you will exit for an even better outcome. So again, when you do trades that are midterm, long term, it's okay to set a very far target and do nothing about it, because you're going to be working on the trade with other trade management techniques. Okay, so all good. But what about when you are doing short-term trading? Let's say you are trading futures intraday in and out. Okay, so this is what I would like to talk about here a little bit. Okay, so I'm changing platform here from Top to NinjaTrader. And by the way, NinjaTrader, I'm just giving you a little bit of a sneak peek of what NinjaTrader is, and it's not on our website yet. It's about to be honest. I know I said that before. It's really about to be. We had some additional delays with the NinjaTrader ecosystem thing, but it's basically all ready to be there, and it's going to be there in maybe a day or two, something like that. Almost, really, truly almost. But anyway, so in this, let me move this away. So in this particular screen, what do I have? Okay, for the ones of you that are not trading futures or are not attending future sessions on a regular basis, I would like to describe this very quickly. In the end, trading is trading, UFOs are UFOs, climate is climate, and things like that. So everything you know about options and trading securities applies to trading futures. So it's what you're gonna see here is not too different, but I will make a point in a moment of something which is important to keep in mind for targets. Okay. So first, let me explain what I have on the screen. So here on the bottom part, I got a 15-minute time frame. This is gold futures. So I got a 15-minute time frame of gold with the climate. So this is the common time frame used for identification of price direction, and therefore going long or going short. Here's the max distance statistics. Here's the count statistics for the auto climate. And based on that, so, not too long ago, you may have said in the last 3 candles, the climate was blue, time to go long. And if price came back to the average like it did, maybe you got long and you caught a short-term trade in and out during the day, which would be caught on either the 2-minute time frame, okay, either the 2-minute time frame or the 610 volume time frame, or the 377 tick time frame, which all of those time frames are pointing at UFOs to be traded in the direction of the climate set by the 15-minute time frame. So this is no different than what we do, just to create a little bit of a contrast and be a bit more visual here. So if I go back to top and we talk about options in the futures, so we have the climate applied to the daily time frame, and then when we're trying to be directional, what I do is I move to the 55-minute time frame, and if the climate is giving us permission to either go long or short, we use the UFOs from the 55-minute time frame to do the trade. Well, because it's securities and it's very complicated to use volume or tick charts, so we just don't do it. Okay. Also because we go with options, and when you get into an options trade, the most you can lose is set by the options. So we don't even use stops with options because the strategy itself has limited risk. But with futures, of course, we have to use stops. Right? So because we're not using options, I mean, you could, but certainly from a leverage point of view and so on, it's more efficient to use futures themselves, and therefore we use stops. So, we are trying to be more precise by, instead of looking only at the 55-minute time frame, we look at the 2-minute combined with the 610 combined with the 377, right? And when price comes to the average, the EMA, and the EMA is being enveloped by UFOs. Okay, and by the way, on Ninja, notice how the EMA is also drawn on the screen as a horizontal line, 1683.7, 1683.7. Same line is here, 1683.7. Same line is here, 1683.7. That's the EMA from the 15-minute time frame, which is plotted on the 2-minute time frame, the volume time frame, and the tick time frame. Okay, so it's a great reference. So again, can I go back in time? But if we were to go back in time, so let's pretend that there was a green UFO somewhere here, right? So when price came into this UFO, you could have bought at this price with a stop at this price, and somewhere above, you would want to have a target. And the question is, where would that target be? Okay, that's the question. And that's what I want to discuss with you today, to make our targets a bit more efficient, especially for intraday trading, because just like I just said, with options, we don't use stops because the option strategies got limited risk by default, and we could afford the fluctuations of the stock even going past our UFO and then come back up, because stocks are fragile. They depend on factors others, such as the industry, competitor companies, etc., etc. But with futures, we cannot do that. We need to use stops. And I also said before that with securities and options, you can get very relaxed at targets because we're going to convert and massage the option strategy to become something else, lock in profits and so on. But with futures, we cannot do that either because we have no time, because we are in and out in just a few seconds or minutes because it's short-term intraday. So the conversation I want to have now is how can we get more efficient with the intraday targets when doing short-term intraday trading, where we cannot get too creative at what happens with the target, okay? Because we have no time short-term intraday. That's what I want to talk about. And sorry to make the intro for this conversation a bit long, but since I believe that not everybody in the group today trades futures, I wanted to create this analogy between futures and options, so you understand why I'm going to talk about what I'm going to talk about, which you could certainly apply it for futures for options trading as well, but I would say it's not needed because of what I said before. Okay, so please give me in the chat box a quick confirmation that you understand that I'm going to talk about targets for short-term trading, and why is it that I'm going to talk about something for targets that you don't need to use for options trading, which is the reason that it's short-term and we don't have too much room to do too much. Okay, so please confirm that in the chat box. So I'm going to get into it. Now, as you confirm that, I'm going to load a new chart. So I'm just going to get a new chart on NinjaTrader here. Okay, so for example, we're going to be looking at the S&P, for example. Let's look at the S&P. And 15-minute time frame, great, because 15-minute time frame is the one I was using for common time frame. So I'm going to go with the 15-minute time frame. Okay, so here's a chart which is being loaded in my other computer screen. Let me bring it here. And with that chart on the screen, I am going to talk about targets now. Okay. Good. Yes, Jeff, exactly. That's exactly what I'm going to talk about, which time frame and how. Got you. Okay, great. Perfect. Okay, so I got a chart, 15-minute time frame of the S&P. Let me maximize this. Let's turn on, you know what? Let me go ahead and open a template because I do not like grids on my charts. This is just a personal preference. Let me go ahead and use a gray color. Okay, I guess gray color will be good on our eyes. And by the way, this gray color has auto climate. I know I don't need that. I don't need the EMA. The one thing I do need is auto UFOs. So let me add auto UFOs. Here we go. Let me get rid of the bar timer. We don't need bar timer for now. Click OK. Here we go. So I got a chart and I got UFOs. You've seen that before. Okay, nothing new so far. So again, let's say you are getting long. Okay, let's say you are getting long with the S&P, and you are planning on a trade to go long. So obviously, this is the 15-minute time frame. This is the time frame that in intraday trading, based on what I just showed you, is the time frame that will be used to assess the climate. It's the common time frame. We set targets using the common time frame, isn't it? So you would basically look at 3905.50 as the target for the trade, and the classical action, the way the way we teach you. For example, if you have attended our futures course, our FOREX course, our stock course on the website, so that's the classical basic approach to setting targets. We look at the same time frame where we assess the climate. You look at the next rival UFO, and then 3905.5 becomes the target. You find a good entry, and that's your target. End of the story. Okay, but what happens? Well, there are times. In this case, the target is fairly close. So the current price, let's say you were entering now, so 39.02 is the entry, 39.05 is the target. That's 3 points. I mean, my friends, if I look at, let me add another indicator. If I look at here, ATR, okay? If I look at ATR, average true range, that market in 15 minutes moves an average of 10 points. So, I mean, reaching a target which is 3 points away, where an average move on the 15-minute time frame is 10 points, I would say that is very doable. So in a case like this, I'd be more than happy to use that target. But there are many times, okay, let's say you were entering this trade earlier in the day. Let's say you find a very good entry somewhere here. Now, could you ride a fantastic move intraday? Yes, of course. But what's the probability to reach 39.05 if you enter the trade at 38.80? Okay. Well, now instead of looking at the 15-minute time frame, maybe a wise action would be to look at the daily time frame. Okay, and if I look at the daily time frame, the average to range is 82 points, right? So if you enter at let me go back to the 15-minute time frame. So I see what I said before. So 80 points, 80 plus points is the ATR in a daily time frame. So this is what that market moves as an average per day. So if you entered, right? If you entered, let's say somewhere, around 38.80, so 38.80 plus 80, right? Which is the average to range, okay? 38.80 plus 80 definitely would allow you to reach a target at 39.05. But what's the issue? The issue is that the trading day didn't start there, right? So if you look at the bottom part of this is 38.50 or something like that. So if you add 30 points, okay, well, if you add 80 points, you may get, to that target located at 39.05, but that would imply, basically as a trader, you're telling yourself, which is way too hopeful, you are telling yourself, look, the average movement of the market is 80 points a day. I'm going to be so good as a trader that I'm going to catch the low of the day and I'm going to ride it all the way to the high of the day. My target is that far, and I am confident I'm going to get that far. I mean, I would say that is a little bit of overconfidence, isn't it? We should make our life simpler when we set targets intraday, where we set our targets far enough so we have good reward to risk ratios, but at the same time, targets that are close enough so actually you have a chance to achieve where the target is. Okay? And what is a very interesting way to do that? Well, one very interesting way to do that is to change the settings of your UFOs on your common time frame. Okay, so if I go back to what I had before, on my chart of the left here, I got the common time frame. It's the same 15-minute time frame. Okay, but notice, number one, that the way I'm plotting the UFOs, I'm only plotting the circles. I am not plotting the bands. But also notice that the settings I got here, okay, if I look at indicators, notice how the settings I got when it comes to hide, hit UFOs, you have the same setting on every platform, okay, on TradingView, on top, everywhere. So that setting is unchecked. Everywhere else is checked, okay? If I go back to the chart I was using before, where are you? Here. So if I go back to this chart and I go back to the settings of auto UFOs, so take a look at how by default hide hit UFOs is checked. So what I'm going to do here is I'm going to uncheck it. And if I uncheck it, notice what's going to happen. I click apply. Notice how many more UFOs I got. Notice how other UFOs were revealed that were in a closer location. And notice how earlier in the day, price came to those UFOs, and notice how severe the turning point took place from here all the way to down here. Okay, that is 90-something to 70-something. That's 20-point drop. 20-point drop is a quarter of the daily trading movement, right? So in other words, if I had entered this market long using a 2-minute time frame, a volume time frame, and I entered somewhere here in the day, earlier in the day, certainly I would have preferred to set my target at 93.25, get out, and ideally re-enter later somewhere here, and maybe now I go for the next target, or maybe I still go for 93 and catch another very nice size of a move, which that's what I would have done. So I prefer multiple times closer targets instead of this amazing target on paper, but then you may get there, or in this day you didn't get it. Okay, And also to remove over analysis, the way I like to plot it to set targets really is also I get rid of the UFO bands. Okay, I get rid of the UFO bands. I even get rid of the UFO price levels. Okay, and basically I plot it like that. So basically I'm just looking at, where are those UFOs? And what I do is I work on the cursor. So when I use the cursor, the crosshair right there, so you can see the price on the right. So depending on where the market is, okay, because each case is different. Okay, let's say for example you take onto a trade long. So please ignore everything below. Okay, let's pretend the market is currently trading here, and let's say your entry is here, right? So where would I take target? I would take target the midpoint where the crossover of the two UFOs are. Okay, let's say the entry is somewhere here. Where would I take my target? The next UFO. That would be normal, right? Let's say I'm entering long here. Where would I take target? The next UFO, right? Because all those UFOs, okay, they may be low probability, but I still need to respect them because they may still create an intraday turning point, which is a smart thing for me to take profits here, even though ultimately it was traded through. That's why, I don't even plot the bands. I don't want to get to overanalyze the candles or the charts by going left and right with my eyes. That's why the way I have it set up here, I keep it very, very small, very minimalistic. Okay, but this is gold. This is a different market. Okay, so that's why it doesn't show the same. But I keep it very small, very minimalistic. Okay, so I don't get to look left and start overthinking about where my target would be. So that way, I maximize the probability of being in and out during intraday, and hopefully being able to re-enter more often without looking for that amazing, perfect book target that is the trader, which is the trade of the year, but only happens once a year. Okay. Anyway, so this is the topic I wanted to discuss with you guys, and I'll let you experience with it. Okay. Again, one last time before we conclude the session. And when you go to indicators in Ninja Trader, but again, if it's another platform, you just right click, go to format, etc. And you just need to uncheck high hit UFOs. You just uncheck it. Again, the application of this is really for intraday trading. This is when it becomes more convenient. When you want to be active, you want to re-enter sooner, you want to exit sooner, all of that. If you are working with options, again, I don't want to repeat myself. Again, could still be an alternative for you guys. You could certainly play with it and experience and see if you want to have it as part of your trading plan. But I would say it's probably more efficient to use for intraday trading. Okay. So last question here on the chat box, Joe. I'm curious if you put a speed bump at the last pivot to the left, where would it line up? Well, we don't have speed bumps on Ninja, so unfortunately I would not be able to display that. Certainly, it would be a nice exercise. You could certainly chart S&P futures on top as well and get the 15-minute time frame and do it there. But remember, I'm not even looking at it, and the reason why is because the rationale behind the speed bumps is to spot price points which are potential significant turning points, which is probably a change of climate, okay? A severe change of climate. That's not what I'm looking for here. I'm looking for active targets where I can exit when it makes sense to exit, but re-enter soon, where the climate may not have changed yet, but I'm out and I'm back in. Okay, so that's the goal here. We're looking at targets from a more active point of view, again, with an intraday application. Again, certainly you could apply speed bumps for an intraday time frame, but and would not be the same rationale compared to what I said. I'll just do it so you see. Okay, so if I load S&P 500 and I look at a 15-minute time frame, sorry, /ES. Oh, sorry, guys, /ES. Why is not giving me the slide? Oh, wait, I know. Sorry. Now, yes, and I look at the 50-minute time frame. So loading the 15-minute time frame of the S&P. So if you looked at speed bump, looking at this, it will give it you here. So still that exit here would not have been achieved. Okay, again, the speed bumps are supposed to be significant turning points. It's a key concept. Okay, but I guess that, this is actually a great visual that hopefully helps to have this well understood. Great question again, Joe, as always. Good, very good conversation here that we're having. Anyway, it's time to conclude the session, guys. I'd love to have one last feedback from you guys, if I could ask. How was it today? How are you guys? I will see you tomorrow again. Is it in it? Tomorrow we're going to be talking about top. We have a top session. But again, as a quick goodbye, I'd love to see your goodbye on the chat box, but also a quick 1 word, 2 word comment about today. How was it? Good, no good, missing questions? Let me know, please, so I collect your feedback before we go. My pleasure, Jeff. My pleasure, my friend. Thank you, Mark. In a way, what I presented is quite simple, but in another way, you're absolutely right. Lots to write down. Maybe you want to watch the recording, think about it, play with it. Again, I know you are passionate about trading, so you don't mind if I give you some homework. At the same time, of course, while I take it easy, especially in a sharpening session, I really don't want to rush it and give you long explanations, often my style, but certainly in a sharpening session more. Certainly I understand your point about lots to write down. Okay, there is the good of it and there is the less good of it. I get you. Anyway, take care, everybody. See you tomorrow again. Keep up the good work. Thank you for joining me on the Saturday. I will see you tomorrow, or if you're watching this recorded, hopefully the session was useful to you as well. Take care, everybody. Bye-bye.